Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty. Hope you guys are doing well. Just wanted to get you a quick market update here before the weekend. And if you need anything for the weekend, let me know. Anything real estate related, we'd love to be able to help you out. So, what I'm going to do is share my screen with you here and get started. All right, there we go. Okay, so the thing that we were waiting on was the jobs report because one of the things that's been holding up, rates coming down and stuff, which you've been talking about, is the jobs market. The jobs market, the Fed wants to see that the jobs market is slowing down. I know it sounds crazy, but the way they're looking at inflation is that there needs to be less spending, which means less job creation, less business development. So, um, you know, y- at the Fed right now, as Barry Habib would put it, you've got a bunch of attorneys trying to act like economists, and they're looking in the rearview mirror of what happened many months ago or last quarter versus what's really going on right now. When you dig into the numbers more, which a lot of them don't or don't know how to analyze the data, actually what we'll see is that, people are starting to cut hours. Okay. A lot of the numbers that are coming out right now have been manipulated. Um, so, this isn't as rosy as it is, even though it's not super rosy, but they're trying to, tell us that, uh, you know, these jobs numbers that came out today weren't so bad. Well, not really the case. Okay, the it's showing that we had a little over 300,000 home or 300,000 jobs that came on for the economy. But again, if you dig into these a little bit more, you'll see their second and third jobs for people because they can't get one good paying job to keep up with the inflation. We're seeing that again, a lot of companies are cutting back on hours, and just a little bit can kind of cut into the whole market. So again, when you kind of dig into these numbers a little bit more, they're not as shiny and bright, and they're not real jobs. Somebody that's working at McDonald's or doing Uber Eats, is not going to be buying a house. Okay. So, in reality, again, the Fed is not dealing with reality as usual. So, we have to point those things out so that these things make a little bit more sense as we go along. The other thing too, is that we see that from last year, our numbers, our sales numbers are certainly down, but our prices are still steadily climbing, not as fast as they were, obviously, but what does that got to do with what's going on in the market? Well, you've got the jobs report, you've got the caution around the Fed's fund rate maybe going up more, although they're saying they might be on a pause. We'll see after these job report numbers come out and how they look at them, which we'll know a little bit more on that, either into next week or by the end of the month at the very latest, on what they're going to do with that. And then we have, one of the things that I've been mentioning a lot that you don't hear enough about, in my opinion, is, uh, besides the treasuries, um, and where they are on pricing, near like 5 for a short term, which is super high, and that has to do with the rates. Then we had, of course, I mentioned this in a couple of videos before, but we had the bank collapse, and then we had the uh, credit rating downgraded more than once. And what happens when you have your credit rating downgraded? You're going to pay a higher rate. Okay, so that as a country is sort of what we're seeing. And then on top of that, Fed's uh, Bowman cautions rise in energy prices could stall inflation progress, calls calls for higher rates. So again, we're seeing that the rise in energy. Why do we have a rise in energy prices? Well, I think we pointed this out and showed the article in another video that we did, but they cut a lot of these drilling leases for oil, and they shut down a lot of permits for oil. And we don't really have the amount of drilling and refinery capacity that we should have. Now we got plenty of oil, we got plenty of natural gas, so we could go nuclear, literally in nuclear power, which is super clean too, tomorrow. But with a lot of the green energy ideas that really enriches China, because the batteries and stuff are made over there, and lithium mining isn't necessarily great for the environment. Windmills, if you take a look at windmills and what they do to the birds and what's around them, these solar fields and stuff that enrich China, where all this stuff is made, it's not really enriching the environment, guys. Where are all those batteries going to go? It's it can cost, uh, in the high 20s up to $30,000 or so for a battery, maybe a low end one around $15,000 for these cars, which are the size of the bottom of the car. So just saying, what I've been saying is definitely a thing. A few others have been saying it too, but out there, but you don't really hear it too much on the mainstream media because sometimes they're just towing the line. But anyway, so we've got the attorneys handling the economist job down at the Fed, and mortgage rate forecast for October um, is going to be higher and higher for longer. Okay. When is this going to subside? Well, hopefully after these jobs numbers get to where they should be and stop being manipulated, and they actually start to kind of catch up with the data, along with your shelter costs. Your shelter costs are going to lag because of leases being 12 months behind and whatever, what they're looking at. And really what they do at the Fed is they're going to take a 12-month average rather than looking at the here and now and where the rents are now, which are much, much of a different number than taking that overall average. So since they manipulate the numbers, they do all these different things, they're looking in the rearview mirror rather than the here and now, what the reality is for you and I and everybody else out there that has to actually pay rent or pay a mortgage and those sorts of things. We end up with all these nonsensical things that come out of left field that shouldn't normally go where they are. So we originally had thought, as usual with inflation, we would have lower rates by now because inflation did overall go down. But then you can see energy costs come in, bank collapses come in, credit rating downgrading comes in, all these different factors that come out of left field because of mishandling of the way things should be operating in a correct capacity. So in any event, that's my analysis anyway. That's certainly Barry Habib's analysis, and that I'm going to steal from him and a couple of others. So anyway, uh, right now, here's where rates are depending on which one you're going with. Now, if you're going with a broker, they're going to be a little bit lower than this. Also, if you're thinking about buying a new home or selling and buying a property right now, besides investment properties and things like that, which could even be, duplexes, fourplexes, whatever, which is some really good data on those and some really good loan options on those. But also, you might want to think about buying a new home, which some of those new homes right now are already built with the options as is, but they're offering, or you have to start, with in our area about an 8 to 12 month build time, give or take a couple of months. But with those, you're getting a lot of incentives to where they buy basically all these loans in bulk, um, to kind of just explain it in a simple way. And then they buy these rates down and they get these deals on them for the home buyer, for you. And every builder is going to be a little different, but we've seen as low as 4.9 for a brand new home interest rate. Yeah, yeah, it's a huge difference. Think about it this way too. If rates do drop, when rates do drop, hopefully over the next 3, 6, 12, we're going to should start seeing a loosening up by the end of the year or beginning of next year. But over the next 3, 6, 12 months, as things loosen up a little bit. And remember, if we go into a recession, rates will drop. That's just kind of how that goes. We'll see an easing too late, of course. We're going to see an easing from the Fed rather than slamming on the brakes. What they should be doing is letting off the gas pedal right now, and actually even a little bit before now. And of course, they were late to the party to begin with when they should have started the raising the Fed's fund rate sooner. But that doesn't the Fed's fund rate doesn't directly affect the mortgage rate, but it does indirectly due to the bond market and treasuries and things like that. So at any rate, over the next few months to a year, we're going to see a little bit of an easing. All right. So one big thing for us and a couple of indicators for us in our area here in the greater Phoenix area, here's something that's very interesting. Because, we're still the Phoenix area, and I'm going to do a whole separate video on this. I'm going to try to get somebody from city of Phoenix who was actually at our office this past week at our brokerage doing a presentation. But, about all the amazing things happening here in Phoenix. We've got the semiconductor, with the advanced chip design plant going in. Obviously, it's not going to probably be fully operational for a few more years, but that is a massive, massive undertaking, along with all the medical and other tech things coming in here, and other businesses and services. It's pretty amazing. So I'll do a separate video on that, but the prices are very, very unlikely to drop here in the Phoenix area anytime soon. Okay. Also, getting back to 3% interest rates, if you're sitting around waiting for that, probably is not going to happen anytime soon. Okay. If ever. Okay. If ever. But so I wouldn't wait around for that. But like I say, we drop 1% or 100 basis points in interest rates, and we'll see about 5 million more people come into the home buyer pool because of just affordability and what they can qualify for. So maybe, not all of them go under contract right away, but that would be a massive thing. So if we, right now we're around 7, mid 7s, up near 8, depending on the day of the week and the hour, with this crazy nutty way they're running the economy. And, if we get down to, let's say, mid 6s or 6, we're going to see, 5, 7, 8 million people come back into the market over the next 3, 6, 12 months. Okay. And again, there's always the new home option, which the builders aren't, building like crazy because everything's kind of slowed down a bit, which is part of the demand destruction that the Fed is doing to slow down the inflation. Even though at the same time we're spending and printing record numbers of dollars, trillions of dollars. I mean, right now, looking at a $2 trillion deficit every year for this country. We just can't go on like that. We've got to stop the spending. There's no doubt about that. We also have to look at, what's going on with the currency, right? So I may do a separate thing on that. But my point is, Maricopa County, which is the greater Phoenix area, along with Pinell, but Maricopa County saw the largest population growth in 2021 and 2022. So they're like the fastest growing county in America. And new home permits are down. So we're growing. People are moving here. And this article, just one example of proving that. People are getting out of Seattle or, the major city hubs anyway, and at least going to the outskirts, or the number one state they're moving to is Phoenix. It's just one example, right? So Denver's another one. that they're moving to in Phoenix. A lot of tech jobs coming from there, medical, like I said, a lot of different industries, construction, So this I thought that article was interesting because of that. So, but with a lot of people think, well, demand's going down. Yeah, but we have like 50% of the homes, 50% of what we should have. So I mean, inventory would literally have to double in order for that to that inventory to really make a difference. So even though the demand has dropped, you know, we're super low on inventory and we don't see any relief from that anytime soon. All right. Because remember, even if people start selling their homes, a majority of them are probably going to be people who also need to buy a home, right? Okay, unless they're an investor and they don't live there. So, these different things are important to keep in mind, right? So, right now, we see just some notes here rattle off. We had right now we're at about 21, just over 21.8, just over 21.8 million sales. So 24% below where we were year over year as far as sales, not prices, but sales volume. Sales overall sales volume is down in the Phoenix area, although there's people moving here still, and we don't have enough inventory. On top of it. So obviously prices overall in the last 4 years, uh, if we kind of look at the last 4 years as a whole, have gone up 68% on average, but sales are down. So the inventory kind of keeps that in balance because when inventory is low, okay, even if demand is moderate, but inventory is low, it's going to keep prices, steadily going up. So home prices overall are unlikely to drop anytime soon. Weaker demand is only, a lower number of sales, uh, not prices due to low supply, 50% below normal. We have a ton of people, that have waited in the past, waited 4 or 5, even 10 years. And now they regret it, because when homes, maybe 10 years ago, you could pick up a home for in the hundreds or 200,000. Now, your entry level is around 4, right? So it's a huge difference, a world of difference. And right now, even if you looked at the most moderate numbers of, on average in the area, the last 4 years, we're coming out at about modestly at least a 10% or more increase per year. So even if we cut that in half at 5%, which is more of a historical number, back before some of this boom that's gone on with the tech boom and medical boom here in the Phoenix area, construction boom and all that. Even if we cut that number in half, you're still in a year probably going to end up, even though you may save a little bit on a lower interest rate by waiting, you're going to end up losing, like 10 times the amount of what you would have, made on the equity and the savings on the actual price of the home. Your taxes, your compound interest. And then if you take a look at the actual refinance opportunity there at, no out-of-pocket cost to the home buyer, then, it starts to make sense. So waiting around, again, if you can't afford it, you can't afford it. You can't take blood out of a stone. But if you're just sitting around waiting for those 3% interest rates or for home prices to drop $50,000 or whatever, it's not going to happen, guys. It's just not going to happen. So mortgage rates react, react to the Fed deal, but it's not a direct correlation. Okay. And the treasuries, looking at that, that's also a big indicator of what's going on, whether you're talking about short term or long term, and whether they go directly correlate with it or not. So right now in the Phoenix area, if we look at the Cromford Market Index, um, we're technically in a mild seller's market. On the index, from 90 to 110 is that kind of that balanced range, 100 being completely balanced. Anything over 110 is a seller's market. Anything below 90 is a buyer's market. So we're at 140 right now. If we look at the supply, we're at 53.1. Okay. Again, super low supply. Demand is higher than supply. Um, Although the demand is low, it's still higher than the supply. So again, it's important to kind of look at, you know, apples to apples and what's really happening here with the numbers. So guys, I think that what we're going to see overall for this year in the greater Phoenix area is probably around, anywhere from 5 to 8%. I would say probably closer to 5 or 6 is what they're indicating overall. Again, your neighborhood, your area, your type of property may be a little less than that, but overall, I think that's what we're going to be looking at. I'll be coming out with some more information about what's going on here in the Valley, which is pretty exciting. One of the things I wanted to make sure I invited you guys to, we're having an open house tomorrow in Surprise Farms. There's the address right there, 18360 West Paradise Lane in Surprise. It's a 4-bedroom, 2.5 bath with a pool on a pretty good sized lot, 2,750 square feet. Great little property. And, you can always text to this number or scan the code here and you can get the information. It'll be again Saturday the 7th. That's tomorrow from 10 to 2. And there's a quick few pictures here. If I can move this over. Okay, there's a picture of the kitchen and the backyard with the pool. And then that's our son, Andrew, with his loan officer info there. And of course, there's our info. So guys, if you have any other questions at all, make sure you reach out to us. And we'd love to be able to help you out with any of your real estate or mortgage needs. And guys, again, and I'll do some more. I've done some comparisons on whether or not you should wait to buy or not. If you can't afford it. I know it's more expensive right now, but if prices aren't going to come down, rates are going to come down modestly, a little bit incrementally over time. Okay. Waiting isn't, and we've already got a very low inventory situation as it is. And seasonally, things here usually, it's like March, April, May, especially April, May. Those are super busy time for us. Really, right after the new year, we see things pick up due to tax season and people thinking about, okay, school's going to be out. I gotta move. I don't want to move during the school year if I don't have to. So people are thinking about that. And then, after June, things slow down a little bit for us seasonally here in the area. Real estate's very local, right? Because it depends on, what kind of town you're in. So for us, after June, things slow down a little bit over the summer because it's super hot. And a lot of people are only here part of the year because of the heat. So they may come back again, like right about now or within the next month or two, or right after the holidays. Some of them even wait that long. So, keep in mind, we usually have like a little bit of a rush in the market towards the end of the year, which happens right about now, right after Labor Day, right up until the holidays. And then when the holidays hit, obviously everybody kind of hunkers in. And then right after the new year, boom, we're right back to it. So if you have any other questions, guys, let us know. It's still a very strong market here as far as we're concerned because of the industry moving in, the economy, the local economy here, the jobs economy here. But overall for the country, I mean, our our unemployment here in the Phoenix area is probably right around 3, give or take a little bit. But we're still building and growing here, and there's so many industries coming in and developing here. Like I said, in tech, medical, all kinds of different services, and we've got all the universities here and stuff. So, like I said, I'll get a separate video done on that, kind of like what's going on in the Phoenix area, things to be aware of, things maybe you didn't really realize was developing or happening here in the valley. And we'll get that out to you here pretty soon. So, also, guys, check out, I just did another video. You'll get it in your email box. I just did another video on um, title fraud and what you can do to protect yourself with that. The county recorder and the governor and the attorney general's office actually got more involved in this sort of scam going on and people's titles being stolen from online. So I did a separate video on that. You can go to our social media, YouTube, Facebook. We'll have it up on Instagram here soon. I think it's already up on YouTube and Facebook. I'll email it out here this weekend along with this video. And then I did another video on for the Phoenix area. We actually have a new bill that passed here recently where we're only one of 2 states that have rental tax for apartments and homes for rentals. And that is going to be going away January of 2025. And that's important. Not only, it's a couple percentage, on some, about 2.3%, depending on the area, for your rent. But it's important to know, for those who are renting or maybe those who are investors or thinking of investing, because of how much easier to be, affordability, but also what you can actually purchase, because they take a certain amount, based on your income and based on the rent amount, and then they kind of figure out what you can afford when you apply for a lease. So super important. I go into it more detail in that video too, along with the title theft and what the county is doing for that, kind of an alert system they have for you. So check that out. And make sure you like, subscribe, follow us everywhere so you don't miss anything as we come along here with what's going on in the market. We'll talk to you guys next time. Thanks.